The Rebel Capitalist Show.
If we think about how a passive fund works, like an index fund, there's no discretion. They don't look at a multiple. All they do is when you give them $100, they have to buy with that $100. That's the only decision-making process they have. If they have $100 come in, they buy $100 of whatever the underlying asset is, the stock. Let's say the S&P 500, the Dow. If they have $100 go out, then they have to sell that underlying assets $100. That's it. Where we know active managers, they're not doing that. They have valuations. They're using other metrics to determine whether or not they buy or sell. So if we take this, if we know that more and more people and more of the assets, the investable assets, are moving towards passive, and if we try to figure that out and take it to its logical conclusion, let's say we get to a point where 99% of the assets are in a passive fund or funds, plural. And let's say on net, of course, obviously they're always having people who want to take out some money and people who want to take and put in money. But we have this baby boomer, a glut of the population retiring, so they're going to want to take out money. But only 1% of the assets are in the hands of the active managers, and they're not going to buy unless the price is right. So let's say that that underlying asset is a $100 stock, and you have 2% of the assets in the passive fund that wants to sell. But even if the active fund wanted to buy at a given price, they don't have the money. The money doesn't exist. So the bid goes from 100 basically down to zero. You have a zero bid. So you theoretically have this model where the stock market could go to zero, and because there's no bid, and it doesn't mean that the underlying assets don't have any value. It's just that there's absolutely no liquidity, and you're stuck there in this passive fund where you literally can't get your money back. And so people say, well, that's an extreme example, George. And it is true that, but the closer we get to that 99% mark or the 100% mark, the more volatility you're going to have when there's net sellers in the passive funds. So I know so many people right now that might not be interested in gold and silver and commodities and these hard assets that you and I are talking about, because they'd much rather be in these financial instruments that have been created by this financial engineering. And they look at Warren Buffett and, he says just go into passive and in an index fund and you'll be fine. And they see this as a quote unquote safe thing to do. But they don't understand the structure and how that's how the structure of the market with the buyers and the sellers has completely transitioned and been distorted over the past few decades. I really wanted to get your insight on that whole concept.
Okay, well, I have a lot of opinions on this, actually. And the real passive investing, actually, even though it was there prior to, it exploded after 2008. That's when the explosion and the big move to the passive happened. ETFs are really exchange traded funds. That's kind of a new financial instrument. And the way that they're structured, they don't really have to hold any cash for those liquidations. So just to kind of add on to what you were talking about, if people go in to liquidate or sell the ETF, right? Well, then that flows through to their approved counterparty, so the bank, let's say, and then the bank is really the one that has to pay out the investors. But what does the bank get? They get the underlying stocks or whatever is invested in. And the range of that investment, typically when you look at the composition of an ETF, is really, really narrow. So where we're talking about, let's say Apple stock. A lot of people own Apple stock, right? But if you pulled up all of these different ETFs, what you would find is that their holdings are primarily the same. And so that's the herding. So you see, Apple going to 2 trillion in market cap, but that's on price earnings multiple expansion, not actual earnings
and not
expansion.
fundamentals, because there's no decision making on the fundamentals. It's only just
Right.
we have more money, we buy. That's it.
Exactly. So the more money that goes in there, but then again, to your point, the more money that comes out, again, there's no decision making. So that's why the Fed had to go in and pump in all of this liquidity in the markets, because the system is falling apart. I mean, it's falling apart. And definitely what's happening in the stock market does not reflect what's happening in the regular market, in the normal economy at all. So for those people, and not only that, but it's this nominal confusion piece. Not, when they created this fiat system, they absolutely knew that people do not understand inflation. And it's genius. I mean, it really is. So, for example, just for people that aren't familiar with that, if you had a $20 bill 10 years ago and you have a $20 bill today, nominally, they're identical. They're both $20 bills. But what that $20 bill bought you 10 years ago or a year ago is vastly different than what that $20 bill buys you today. So by pushing the stock market up and inspiring people to stay in it and put more wealth in it, well, what does that mean? Let's say it goes to 10 trillion. Well, 10 trillion times zero is still zero, because this entire time, the purchasing power value of those dollars is declining. And that's the only thing you can convert those things into, if you can actually convert, which is what my concern is. And with these ETFs and the passive investing, I mean, 100%. How many trading halts did we have in March?
Yeah, right, exactly.
And because it was invisible to most, because they don't really, the system is made intentionally complex so that people just think they can't get it, but you can. And whether you're a passive manager or you have a passive index fund or even the professionally managed ones, what are they playing with? Other people's money. Sorry. But, when you look at what's happening to the pension plans right now, and the law was recently changed that allows them to go into private equity. And do we not remember all the unicorns that were, coming to the market, and they had zero, I mean, seriously, no earnings. In fact, massive losses as far as the eye could see, but yet they had a $20 billion valuation, market valuation, because of the private investing. And then when they came to market, even Levi's that had some positive cash flow, right? And who doesn't know Levi's, right? But they came to market, they got bid up immediately after they came to market, but they have no earnings. They have losses. How does that make any sense?
Yeah, it's financial engineering. Yeah, I think it's just forced upon the average individual since 1913 through inflation, because they have no way of getting ahead, Lynette, because their savings are decreasing in value. So the only way that they can increase their purchasing power and have some prayer of retirement is if they go further out the risk curve. And that's by going into financial assets like these 401ks, these passive funds that we're talking about, where people really don't understand the true underlying risk. And if we could somehow get rid of the central planner's ability to create more currency units, it solves everything. It solves everything.